Earlier this week, Federal Reserve Chair Jerome Powell delivered his speech, and the market was expecting some sort of a hawkish tone because the stock market is all-time high, the Bitcoin is all-time high, the gold has broken all the records, the GDP is pretty decent in the US. So the market was expecting that the Federal Reserve will come out as hawkish as it can be to basically cool the market down a little bit. But in fact, he came out completely opposite, and the way he delivered his speech was completely dovish. And he also said that he is going to cut rates 3 times in 2024. But he also said that he has to look into the data as well because he is not convinced that the inflation is under control. So is it not confusing? Because at the same time, you're telling the audience that you're going to cut rates 3 times this year, but at the same time, you're also telling us that you have to look into the data because you're not convinced on the inflation front. So which one is it? And this makes me think that Federal Reserve doesn't control the market. It's the market participants, they control the market. So Federal Reserve can only push their narrative out to influence the market participants to take actions, and actions means investing, continue spending the money, and drive the economic engines. That's all they do. So they can only push their narrative out to influence the market. They don't control it. One example I can give you is if you look at this chart. This is basically the comparison between the rate hiking cycle and the financial conditions. So you can imagine when they started the rate hiking cycle, in 2021, you can see the financial conditions were getting much tighter along with this rate hiking cycle. But at some point in 2023, we are seeing, and the financial conditions are not tight anymore, right? It has been loosened since the end of 2023. So there is a big divergence between the rate hiking cycle and the financial conditions, which explains that the Federal Reserve doesn't really control the financial conditions. Another example I can tell you that if you are aware what's happening in Japan lately, so Japanese central bank, they announced that coming out of the negative interest rate territory. So they were the only bank keeping the interest rate in the negative zone until now. It has been going on since 2007. So after like 17 years, they're now finally coming out of that negative territory. And during that time, the Japanese capital, which was not, of course, getting a lot of incentive in the local economy, it was fleeing out of Japan and investing their capital in the foreign equity markets like US equity markets, Canadian equity markets, European equity markets, as well as the global bond market. So one of the major reasons of the liquidity supply in the global bond market and the equity market is the Japanese capital, right? So keep in mind that Japan is the largest US treasury holders in the world. So when you have the Japanese capital coming out and being invested into the US equity markets and global bond market, that was one of the major sources of that capital influx. And now if the Bank of Japan is going to raise the interest rate, this will make the local market more attractive for Japanese capital versus the global markets. This can pull some strings for the capital to bring it back in Japan. That could be a bearish signal for the global liquidity. So this makes me think that Federal Reserve is just playing with their narrative. Okay, they don't control anything. They only push their narrative to influence the market. And right after that, our central banker, Mr. Tiff Macklem, also announced they're also going to cut rates in 2024. They have disagreement between themselves on the timing. Well, if you don't know when you're going to cut, why are you telling us now? You see, this is just a narrative that they're pushing out. They're pushing out this narrative so that the market can still keep pumping up and the consumers can still spending money in the economy. That's all they do. They send this narrative out so the market can still pumping up money in the equity markets, in the bond markets, in the consumer market, so that it can somehow engineer a soft landing. But here's the difference between the US and Canada. US economy is much stronger. US homeowners are in much better shape because they have locked their interest rate for the 30 years term, versus in Canada, we only can lock up until like 5 years. So the Canadian homeowners are literally struggling, and as their mortgage renewal comes up, they will be renewing it at a much larger rate. that is going to be a big drag on the Canadian economy. So I think Bank of Canada is going to wait for Federal Reserve to cut the rates first, because otherwise they will risk the Canadian dollar to crush against US dollar because of the interest rate differential, because your import becomes expensive and your interest rate doesn't really attract the foreign capital in the local bond market. So all of this is a psyop, guys. So don't believe that these central bankers are going to control the market. They can only push out the narrative. It's the market capital that drives the momentum, and they can only do that based upon three things: risks, future inflation, and growth projections. That's all it matters. Okay, so the big money, the big and smart money moves based upon these three things. They can assess the next market move based upon these narratives from the central bankers, and that's how they place their bets. Okay, but central bankers, they don't really control the market. Anyway, you let me know what you think about that. Put your comments down below, and if you like this video, give me a subscribe and thumbs up, and I'll see you in my next video. Bye.